Hello, this is Joe Pryor, the virtual real estate team in Oklahoma, and our team specializes in investment real estate in the Oklahoma City and Tulsa markets, primarily single family and some multifamily. I want to talk about rates, and that is something that for the last year and a half, really has been troublesome. This has been a very difficult year for investors because rates really climbed a lot, and then we've had negative cash flow in most of the parts of the country, especially the parts that have really gone up a lot, where 20-30% increases, and then these rates come along. But things are looking really good right now. Obviously, and I've talked about this before, inflation is now to a great extent under control. And so the Fed in September lowered rates 50 basis points, and we got an immediate bump out of that. So in other words, where we were at about 6.625 with points for an investor, we went down as low as 5.25%. That's on a 30-year fixed loan. But then a jobs report came out and was way over what an analyst thought. And this is what happens. All of a sudden, rates go back up again. They went to 5.625, which is still a heck of a lot better. Still another point off what it used to be. But then just a little while ago, not that long ago, the Fed came out and said, hey, we are now with total inflation at 2.4%. Now remember, 2% is what they set as the rate they wanted to get to. And it's been steadily going down. So, for a lot of us that are basically amateur economists, it looks to me like Jerome Powell has really managed this without having a recession. Which is very positive. And so, with that happening, then I'm recording this on a Saturday. I'll be looking at rates on Monday, and we'll see what happens. But my expectations is that the rates are going to go down. Now, with that 2.4%, it takes a lot of pressure off the Fed to hold steady. And so basically the betting at this point, and remember, if it's 60% that says it's going to go down, then there's 40% that says it won't. But what we're expecting from the Fed, at least a consensus, is that we'll have one or maybe even two more rate decreases coming fairly quickly. Could be even this month. So what that means is if we can get two rate decreases, it means that rates really come down from that 5.625, maybe with points below even 5% by the end of the year on a 30-year fixed mortgage. This really puts you in a fantastic situation because the market is also going to increase in appreciation, and that's what happens. Rates go down, the market starts really getting strong, and I'm going to talk about that in just a little bit. More people are buying, which drops the supply, and so you have properties that are going to be going up in price. And appreciation is one way you really make a lot of money. But on the other end, you combine this with really strong positive cash flow, which we have in Oklahoma City and Tulsa on single family homes especially. And then what you get is an incredible annualized return on investment. We look at return on investment, we analyze it, and we calculate it on every home. So if we're like 16, 17, 18% pre-tax returns every year for 7 years, you're on easy street. Great time to buy. Rates are going down. This looks like a very strong market to end the year.